Hello again, this is Peter Bell. Got some notes to share. Trying to think my way through what the terms of this thing might look like. Wanted to point out there's quite a lot of potential value in options based on this cash flow profile. Poke around and see what you see. For example, this is a situation of a $20 in the money call. That's $20 of option premium per kilogram of production. It's a very significant sum.
Contract can have a variety of currencies. The capital that is being contributed should be Canadian. The returns, the proceeds of the activity should be in US dollars. The proceeds would not be earned necessarily in the United States. They could have nothing to do with the United States other than being conducted in US dollars. It might be done in Singapore and Canada, or it all might be done in Canada, or it might go any other number of countries. There's a lot on the plumbing side of the business. So there's an initial payment and then there's a final distribution. In the simplest terms, 2-year term and proceeds based on first tranche of production from Geomega in Nord. See their guidance of 1 to 2 million Canadian as capex for a deal. 1 to 2 million Canadian yields 150,000 kilograms approximately over the first 2 years of production. I believe it's quite a strong return with the basket price at $66. So I would, look at Geomega's economic guidance. It's important as an example of relevant numbers. It's also all non-43-101, which is really interesting. Now, Medallion hasn't produced any economic guidance as yet, but there are some indications it could be good as well, and that it could also produce similarly small amounts of rare earths for relatively small capex. It's different, but it's similar, and if Medallion could earn a profit margin on their operation, then they could offer some of that margin up in some way as a financial derivative, right? It's just about finding the right buyer and coming up with the right deal terms. So those deal terms would probably look different for Geomega versus Medallion, but to some degree, from my perspective, they don't necessarily have to, right? If you abstract from the fact that it's a low capex new producer who needs capital and has a very low capital intensity, right? Very low capex scenario and fair production profile, conservatively, right? possible to try and sell, if the first batch of production over some time period, some scale. Again, those scale numbers are going to be different for Geomega versus Medallion. We don't really know what the numbers are for Medallion at all. We have some initial guidance from Geomega, and their numbers are relevant. Again, talking about 1 to 2 million Canadian capex, and then a profitable operation at 150,000 tons, 150,000 kilograms. Sorry, some fair amount of production. The bigger question is, what is the contract based on, right? And it's possible to just sell the profitability associated with the NdPr, and for the producer itself to keep the dysprosium, the other stuff as a sweetener, if there's dy in it, right? Geomega's provided guidance on that. Their basket is weighted by NdPr dy TV. So if they were just to sell a derivative on NdPr pricing, then they could keep some of the gravy, arguably the best revenue stream, the largest in some sense, largest in price but not in volume. Point being, focusing on NdPr for the buyer's perspective, it's simpler. And if you look at the marketing of like Peak Resources, the front page of their economic study has like big $32 sign on it, NdPr, because they're just focused on branding NdPr, neodymium, praseodymium. Like, they're a vertically integrated production that's like mining in Africa, I believe, and shipping to the UK for refining. Like, very sophisticated global operation, possibly best new mine project, and large scale. I don't recall the production, but larger than Geomega's guidance here so far. And corresponding much larger capex too. So how much is much? I don't know. But it's not 1 to 2 million Canadian to start to produce 150,000 kilograms in 18 months or less, right? Geomega could probably hit 150,000 kilograms in 15 months, which is 10,000 kilograms of their rare earth basket per month. They talk about a price for that basket of like $66 a kilogram. Currently, company has no significant revenue, no significant cash in the bank either. The intellectual property is worth a fortune, but capitalizing it, realizing that, is a big challenge. So there's a need for capital to make this business step up to the next level, and raising capital is always a question. It's not a lot of money, but so far, to some degree, this is a science project, right? There's been a lot of university research, government money put into this, and it works, but it has to be increased. And until somebody starts spending millions of dollars on production and building a facility in Montreal and taking large amounts of shipment, until that really starts happening as an ongoing business activity, it's just a plan. It's a plan in action, but it's not the same. So the need for capital is there, and the question of how, right? And so there's various ways equity in the company, equity in the project, debt in the company, debt in the project. You know, equity company distinction is always very important. I love thinking about, you know, project level equity, because it separates the company and the project. And, you know, if one company can have several projects and assets, you know, that's a good thing, especially for speculative companies. Although success seems to require a fair amount of focus, and that can also be important for companies. So note that Enord is not a public company itself. It's a subsidiary of Geomega, and Geomega's public. Enord isn't. Enord is basically the research company that runs on a shoestring budget that's making all this cool science happen. And the question is, how do you finance Enord into production? And I've suggested spinning out Enord, you know, at the point where it's making $10 million in revenue, which could be the base case in the first year. Spin it out as a new pubco with 10 million shares, right? And you know, make those as a special distribution pro rata to Geomega current shareholders as the simplest possible case. Geomega could hold Montviel, the rare earth hard rock deposit in Quebec, separately. You know, there's potential for those two things to work together, but the market might ascribe bigger value to the collection of assets separately in that case. I think Montviel is like seen as a lame duck, or too big, or to work, or, you know, a bridge too far, unrealistic at this point. But I don't know anyone who doubts Enord. You know, Enord sells rare earths on their website as, you know, for trial sampling, product testing purposes, right? They have given out sample runs and have done some scale of processing. The goal is just, how do we get them financing to do more? And my favorite answer that nobody seems to want to talk about, or is ever talking about, is for Enord to get creative with selling, you know, as I said, pieces of its profit margin, right? So, it's really hard to tell what that profit is a priori, but if you come up with the right financial contract, it's not impossible. And the simplest contract is you know, a call option or a contract for difference on NdPr prices solely, you know, globally in some sense, as a reference price, and then for that buyer of that financial derivative to, you know, to allow Enord to sell the product. So, you know, it's in the modeling, it's a realized price, what the material is actually sold for, versus some benchmark that's set beforehand, you know, in the most simple approach. So, for example, with their $66 basket, you know, I've talked about a $50 strike. That's because I, you know, think an in the money call makes it so that the buyer of the derivative is effectively long, which is a good thing. It's what they want. So I've said it before, I repeat myself, but, you know, hammering it all out and trying to get it there so that we can get some kind of transcript and work towards a term sheet. You know, that's the real goal. I wouldn't even know, you know, what to put on a term sheet for this contract, right? Like, you almost need to put nothing, really, like very, very little. You know, what is the bounds? Well, somewhere between 0 and say 150,000 kilograms to be delivered over 15 months. Well, to be produced and sold over a period of 15 months. And at the end of that 15 months, there's a settlement made as to the difference between prices sold at and reference price. That's the simplest possible terms, or even to give them no choice, and then just to say, you're taking it all. We want a buyer for the full first batch on a CFD to a $50. Well, and then push it all the way. The simplest one is, we think it's the full production over a 15-month run of a Nord, targeting 150,000 kilograms, and with an expected basket price of 66. The buyer takes all of the production and all of the price above $50 a kilogram on the full basket sold. That is a brilliant deal for many reasons. Primarily, it gives, it keeps Geomega, or it keeps Inord as having an incentive to find the best product, right? Well, arguably it doesn't, because Geomega is getting a fixed price. So that's a concern, right? If Inord's getting a flat price, maybe it doesn't care about getting quite the best material and finding quite the best buyers. They might wait until month 16 to process a bunch of waste that's identified as feed that's really high grade. So there may be some adverse selection or moral hazard or game theory of one way or another going on with that you want to point out. I don't know you can necessarily mitigate it too much, other than identify it and try and quantify it and show how you're doing better than. Does Geomega want to give up all of the upside on price for their first run of production? That's a huge question. I think the answer is clearly yes. If there's a company that can give up their 95% of their expected profit margin to get into production, and they did it, imagine, run the scenarios. Imagine they did it and they make a bunch of money. Sweet, everybody wins. Imagine they do it and they don't, do really well. They probably, maybe even there's losses, right? They probably say, well, it's good that we use risk capital instead of debt, because we're still in the game and we can figure out why we had this loss. Was it just soft markets, or was there some other problem? Can we do this again, or do we need to put this back on the shelf, right? If you do that with an option premium, if that production was financed with an option premium versus as if it was financed with debt, very different story for how you look at the world on the other side of a bad first run. So in either case, it's good if you take the money from the CFD from Inord's perspective, right? Really simple, but just in either case, you're glad you did, right? There may be other ways to finance it that may look good too, and it may be smart to adjust this in some way or scale it back, or maybe even scale it up and increase it too, right? Depending on who's at the table, what kind of stuff you're going after, what's realistic. But from my perspective, as a third-party speculator, I look at public news, right? And the news from Geomega provides guidance on Inord, and that guidance looks good. And I can draw up a scenario where, Geomega, Inord can sell someone a financial interest in the project, right? And get it financed to a large degree. And as I say, if you design that financial derivative so that it has no recourse, right? you know, in terms of imposing a penalty on Geomega shareholders, or a debt, or any restrictions on future business, a royalty, say, on money on future attempts to do the business with Inord, you know, that's the only thing you could give out on a loss. You know, if somebody bought CFD to finance initial production, the only thing that you might grant them if things go bad is a royalty on future production. So you might grant them a 1% royalty on all future production. You know, that's probably way too valuable from Inord's perspective to give away at this point. But again, if you do the kind of calculation I did before, where you consider what would happen if you did it and things went well, or if you did it and things didn't go well, again, right, it's thinking in that regard with regards to the the royalty that could be offered in the case of things going badly. If you did that again in that circumstance, I think you'll find that giving the person a 1% royalty in the case where things didn't go well the first time through is a very, very good business decision. So that's the only possible terms that come to mind about what the CFD buyer would get if things didn't all, you know, turn up roses, is a royalty on future production, you know, some participating interest, or maybe something off the top line, you know, maybe 0.1% off the revenue of all future production. You know, if you don't really know what is going to happen to the profit numbers for Inord, it may be that taking some of the revenue is very smart, and something that Inord feels more comfortable doing in the case of things going wrong, which is the most likely outcome. So that's why it needs to be $1 million Canadian of capital that can go to capital heaven, right? Like, this isn't just high risk stock investing. This is like institutional stuff, right? Which is why I've said, like, if some house wanted to take this and try and securitize it again, it's, you know, that's something I know nothing about. But is there demand globally for exposure to rare earth economics? The answer is yes, of course. Any revenue stream associated with NdPr is valuable, let alone the physical side, which is very, very valuable. So it all kind of comes down and clarifies in terms of, like, all this stuff I've been talking about is a term sheet for one case, basically. It's a term sheet for the financial buyer who wants some exposure to price uncertainty for rare earth. There's another set of terms to consider, which is the physical buyer. So, physical buyer is just unheard of, right? Even me talking about physical buyer is kind of ludicrous, but, you know, talking about it in the same breath as the financial buyer, like, what physical buyer is going to take a contract for difference? I think the purchasing agents will laugh at you. You know, I think a lot of the buyers are used to really favorable terms and juicy margins, and maybe it gets competitive and stuff, but I think it's a pretty rich business. Physical guy, you know, the physical buyer is more likely to want offtake, you know, because they're planning into production chains, right, for products, with forecasts on, you know, demand and shipping constraints and stuff too, right? Their whole production profiles of, like, consumer and industrial and all kinds of, you know, technology goods. batteries, motors, everything, right? The motors, key thing with NdPr, motors. Offering a physical buyer a CFD is kind of a joke at this point. As I say, they're more likely to want, offtake stuff, and I would think that you would almost be paying them to give you an offtake at this point, because you look at what happened with Linus again. They had a recent quarter where they, I believe, stockpiled production and said in the financials that prices were too low, so they have held back sales of finished product, which is very concerning to hear at a time when you're also hearing things about, the Malaysian government giving them uncertainty around the future of their plant. So, to some degree, the fact that Linus is stockpiling says, that there aren't that many buyers out there, right? And if you come to market with a lot of product at the wrong time, you're not going to be doing very well, right? And that can be somewhat reflexive because you get into the macro and the fact that China can push its weight around in this market to a fair degree, and you think, well, okay, that kind of means, throw the economics rulebook out the window to a large degree, if you're going to be a large producer, right? And arguably Linus is a large producer. So would it make sense for the Chinese to try to push them out of production and, instigate whatever kind of social discord might be happening as well, too, to contribute to that? I don't know. It's Confessions of an Economic Hitman book reference, right? So the fact that Linus can't find buyers means there's probably no physical buyers who would take a CFD at this point. But that doesn't mean that physical buyers shouldn't, or that in some case in the future, physical buyers wouldn't do more CFD and price hedging, really, because that's all it is. I'm sure they're well aware of all this stuff. I just have no clue. And so there's so many, things to discuss about all that. And it's like, well, why would you have a separate term sheet for physical buyers if you're not going to have any physical buyers? And the answer is, well, because you might, right? And so, to tie it all up, what you do is you design your term sheet for your financial buyer, and then to change it for your physical buyer, all you do is say, instead of us selling it through our sales agent in Singapore, we deliver it to you in some way, right? So that's not even necessarily separate term sheets at that point, right? Like, that's just a pretty minor item to most people's way of thinking about it. But it's really not, right? It really is a significant difference, right? It's the difference between financialization and not, and physical production, right? So whatever business development activities are available for raising capital and conventional sources, by all means, use them. But the potential to have some financing associated with some call option, for a new producer to use, negative option, to sell option premiums, to sell options. Selling options on something you control, right? Who's going to buy that? Physical or financial? That's a big question mark. But if you think of options as insurance in some way, targeted, it's, I don't know. I don't know what the term sheet would look like, and I don't know if there's a separate one for the physical and the financial, but fun to think about what it might look like. and try to put pen to paper here before too long too. And it's in there. You know, I went through the most simple version a couple times. It may have gotten spread around in different parts of the recording. I can try and repeat it. But if you can just carve out some really simple points that explain what you could do there, you know, it pins things down. So in the same way Geomega publishing guidance on ignored economics, you know, gives me ability to fiddle around with this kind of modeling, publishing, you know, my own models of what a CFD on this stuff might look like, you know, lets other people do the same thing. And then posting it on the internet, make it free for anyone to listen to and find and try and understand. So that's the marching orders here. Stop for a bit. Thanks very much. Peter Bell again.